For most people, investing for retirement means building a portfolio of index funds and exchange traded funds to make up an entire portfolio with ultra low costs and excellent diversification. So in today's video, we're going to be talking about how many funds do you need in your retirement portfolio. And there's a lot of different views on this. So I want to cover all of them. When you look at the funds that you need during your retirement account, many people do 3 funds, some do 2 funds. We even see portfolios that are comprised of just one single fund in its entirety. So how do you choose funds for retirement? When it comes to building a well-rounded, diversified investment portfolio, it is a job of retirement investors. So when it comes to mutual funds, when it comes to index funds, making up and looking at hundreds or even thousands of individual stocks that are inside of these funds themselves offers instant diversification. Owning too many funds or owning the wrong sort of funds can really prove a really big problem if you have a lot of overlap, which we've talked about before, where if you hold 2 different ETFs or 2 different index funds and they are carrying and holding the exact same duplicate stocks, which means diversification really isn't there, even though you think it is. And you want to make sure that you're careful with this because of that overlap. Now, when it comes to robo-advisors, they recommend 3 to 5 funds in the portfolio, again, to get that well-rounded. Now, when we start considering which funds are adding to the portfolio, you have to think about what do they cost and what is the diversification. When you're looking at ETFs, are you going with ETFs? Are you going with mutual funds? So the right way is to opt out of funds that are going to have a really strong overlap, and you want to make sure the diversification is there. And a lot of people say to bring in bonds. Now, this is a point where me personally, I do not choose to invest in bonds. And the reason being, there have been a ton of studies, there's been a ton of information that have kind of come out that said, if you kept your investment portfolio fully invested without bonds and just kept it into like an S&P 500 fund during retirement, you would have not run out of money, or you'd have enough because of the growth factor that you have in there with the very low expense ratio. So then, of course, the question, how many funds do you need? Well-diversified portfolios run about 3, 2, or even 1 funds, depending on the diversification. So let's start with the 3 ETF portfolio or the 3 fund portfolio. This is made up of indexes or ETFs, which a lot of people use the US total stock market. Now, this is like the Vanguard, the VTI, which is the total index. It is the total United States stock market in its entirety, holding, I believe it was around 3,600 stocks, then having a segment into international stock funds and a broad market bond fund. Now, again, for me, looking at this 3 ETF portfolio that Forbes talks about, I choose not to invest in international stocks. And the reason being, when you start looking at a broader picture of most of the companies in the United States, they are global companies. When you think of, looking at Meta, thinking of Amazon, thinking of Nvidia, Apple, most of them are global companies, meaning they're invested into every single market pretty much around the world when it comes to diversification. And even if you look at the last 30 years, there's only been a handful of years that the international markets have outperformed the US markets. And even with the last 2 years, the US markets have been doing incredibly well. Now, when we start looking at the broad market bond funds historically, even looking at like a BND, have returned about 2 to 3%, which if you know anything about inflation, that means you're getting a negative return for being in those bond funds. And I know in a down market, everything like that, you're not going to see the bonds go down, but I'm willing to offer a little bit more risk and a little bit more diversification. So stocks have always delivered a better return than we see with bonds and cash over the long term. There's a ton of breakdown, even looking at the S&P 500, which averages about 10%. Well, bonds have an annualized return of about 5%. So you're talking in this similar period, you're getting 50% less of a return over an extended amount of time. Younger people, more risk tolerant individuals really should go overweight into the stock market. So the way that we look at this is when you think of the heavy tech stocks, you're looking at something like the QQQM or something like the VUG, something that is very heavy into the tech side. This is the point where if you're in the younger generation or you're willing to take more risk, you're going to put a majority of your portfolio in there. We're talking 40, 45% of a portfolio. So let's say, we just put 40% there. The second part of this portfolio, instead of doing the international fund, I like doing the US fund. Now we do something like the Vanguard S&P 500 or the VOO. That is where we put everything. And of course, there is overlap. Now we talked about this before. When it comes to the overlap of these two, we are much heavily vested in the tech sector, which of course can be extremely risky or have a higher risk. I wouldn't even go as far as saying extremely risky, But instead of the broad market bond fund, I go for a dividend ETF. This is where I hold my HD, which comprises all of my 3 ETF portfolio. And as of recently, we actually took a very small portion and put it into the Bitcoin ETF of about 5% to really round out that 3 ETF or that 3 fund model. Works incredibly well because for a majority of investors, you'll have the diversification there. Because when we start thinking of what we have in the QQQM, which is the NASDAQ 100, we're tracking the 100 companies within there. We have the S&P 500, which covers every single sector, owning over 500 stocks within there. And then the HD is more of a staple where if we see a lot of volatility in the stock market or even a lot of volatility within the tech side, the HD doesn't have quite that volatility because it's more driven by these staple blue chip companies that are going to be around and that have paid dividends for an extended amount of time. Then we get into the 2 fund ETF portfolio. Now, when you look at legends like John Bogle and you look at Warren Buffett, they have advised that a 2 ETF portfolio is the way to go. Now, when we start looking at the asset allocation, they're looking again, a total US stock market. So something like that VTI, and then looking at a total US bond index would be the only 2 that made up this portfolio. So again, it's very interesting. When you look at Warren Buffett's suggestion, his 2 fund ETF says 90% allocation into the S&P 500. So when you think about 2 funds that you're holding, let's say you hold the VOO at 90%, 10% going into US Treasury bills, and that is it. This is going to be the portfolio that you are going to hold with this 2 fund approach forever, all the way through retirement. You're not going to allocate any different. You're going to go ahead and put that in there. And he believes, and the quote is, I believe the terms or the trust long-term results of the policy will be superior to be attained of any investors, whether it's a pension fund, a financial institution, or individuals who employ any high fee managers. When you start thinking about management cost and you think 1% adds up very, very quickly over an extended amount of time. And of course, when you start getting into the $1 million, 1% really makes a big difference if you're giving it away every single year, regardless of the market being up or down. So definitely makes a big difference with that 2 fund portfolio. And the last one we get into is the 1 fund portfolio. So when you think of a 1 fund, just holding one single fund, most people look at this as a target date fund. This is where they do come into play, because when you think of a target date fund, it is your entire retirement portfolio into one single fund. Instead of buying an ETF, instead of buying a mutual fund, instead of going into the bonds, it buys a broad portfolio of different mutual funds or the funds of funds. So they are building these portfolios. We see it with Vanguard. We see it with a lot of where they might have a 2060 fund, a 2065, a 2070 fund. So depending on your retirement age, that is the fund that you should be in. Named for the year that you plan to retire, target date funds adjust and really change their holdings to a risky position to almost no risk as you get closer to retirement. So what's happening traditionally, though, is we are seeing a lot of these target date funds is that as they adjust, as you kind of go through time, it's getting to the point where a lot of the money is then held in bonds. The bonds are growing at a very, very low rate. And people are finding that if they do not have a mega large or very large portfolio, they're running out of funds during retirement. Like I said earlier, a lot of surveys are coming out, a lot of information, a lot of data, where if they kept the funds into something like an S&P 500 fund, even taking the regular withdrawals out of there because of that 10% growth factor, that is the average of the S&P 500. People are not running out of money or would not have run out of money if you went in there. Now, when we start thinking again of this target date fund, it really has a greater portion of stocks which shift to the allocation of bonds as you grow older, trying to preserve capital and generate income. But when you look again at the bonds versus something that is a dividend, it doesn't make sense. To me, mathematically, historically, it doesn't make sense for me to invest money into the bond market. And I know a lot of people do not, because we have these dividend ETFs that are super cheap. I mean, a 0.06, when you look at the HD, is a very, very cheap with a good return of a couple percent, if not higher, depending on what you Now, once you choose your target date fund, that's all you have to do. It's automatically contributions are going in there. The fund manager handles all of the money. They periodically rebalance the portfolio, making sure that the adjustment of stocks and bonds are really where they want to be in relationship to the target, and of course, where the fund is. So, guys, that begs the question, how many funds do you carry in your retirement? Are you going in there for the single fund, just holding one in its entirety, and it is a target date fund? Are you doing two? Are you doing three? Are you doing more? Can we do 5, 10, 15, 20 different funds that you're holding in there? Let me know in the comments exactly what you're holding in the portfolio. I will definitely break it down and answer any questions that you have. And of course, thank you guys for watching.